Good, good. Thank you for having us. We're the last thing between you and happy hour, so we're going to keep this as brief as possible. But the whole day today, you've gotten to hear from the investors, you've gotten to hear from companies. This is the panel. This is the time for the founders and the fintech companies to hear from the investors. So we're going to kind of gear the questions towards that goal. As Dan said, we've got investors up here from many different stages in the fintech investment life cycle. Before I let them introduce themselves, let me introduce myself. I'm Matt Kennedy. I'm a vice president with Bank Street Partners. We are an Atlanta-based firm, but I work out of our Charlotte office here. We advise community banks and fintech companies on M&A transactions and capital raises. We're actually, as you saw earlier, working with VentureSouth on the capital raise right now for their firm. I'm going to turn it over to these guys, and you guys go ahead and introduce yourself, name, firm, and investment stage, where you are in the investment stage life cycle for some of these fintechs.
Okay. Hey guys, Lackey. I'm actually a native Charlottean, so this is exciting for me to see this kind of growth of our ecosystem here. I've been a career entrepreneur, been fortunate to have grown and sold a couple companies, and after my most recent exit, I became a partner in VentureSouth, which is one of the largest professional angel networks in the US. So we invest as an aggregated group of 250 angels, putting capital to work here in the Southeast. So I'm here representing that group today.
Hey, I'm Richard Maclean with Frontier Capital. We're based here in Charlotte. Started the firm in '99. I think that's about the time I met you. We're headquartered here. We're sector focused on software, and our investment strategy is really all about growth. So we specialize in investing in $10 to $20 million revenue software companies that are at an inflection point where they really need kind of a new playbook for that next stage of growth, and you have a team and an investor base that's done a fantastic job kind of getting it to that stage. But that's really kind of a natural inflection point for a lot of companies to consider a recap. So the companies that we focus on are sub $100 million in enterprise value. Today we'll sort of write a $40 to maybe $70 million check to buy what's typically a majority stake. In those businesses, we have a North American focus. We're on our fifth fund, but we are huge supporters of the Charlotte kind of tech community. We've actually had a lot of success here in the Carolinas. It's really kind of our roots, and so happy to be here, and it's great to see this conference really getting this kind of traction in the second year.
Good evening, everybody. My name is David Hall. I'm a partner with Washington, D.C.-based Revolution. We've got a number of funds and $1.3 billion under management. I'm a partner in our Rise of the Rest early stage fund. Rise of the Rest is sort of the mission and the brand that we've been able to build going across the country, having visited over 40 different communities that aren't New York, that aren't Silicon Valley, and that aren't Boston. We think that those are pretty mature but yet closed ecosystems, and we think there's a whole country of opportunity, literally, if you exclude those three cities. And one of the things that we've done is we raised this $150 million fund almost a year ago to expedite capital into some of those regions. We've invested in places like New Orleans, Miami, Pittsburgh, Albuquerque. We've invested literally all across the country into businesses. Given that we see sort of opportunity largely through the eyes of geography, we're pretty sector agnostic. But when we invest, I like to say we're seed stage, which isn't necessarily seed round, particularly in some of these rising cities, because a San Francisco seed deal might have to be a A round or sometimes even later in communities like Nashville, because the lack of early stage capital has created opportunities for those founders to have to dig in a little bit harder and find more alternative and interesting ways to be financed through the point where they could raise institutional capital. We like to come in early to the company and be among the first institutional checks, but our model is to sort of dip our toe in with the first check and then double, triple, quadruple, or more into the companies that have shown the most amount of progress in our portfolio.
Thanks, guys. So, David, that's a good transition in the first topic I want to talk about, and then specifically the investment ecosystem. What's going on with fintech investing in the Southeast? Historically, a lot of the money has come from the Valley and New York. Do you all see that changing? Is it easier for some of these founders in the Southeast to get local, investing local money?
So, I mean, look, I think, as it's been said several times today, it's hard to raise any kind of capital anywhere. I think that you're seeing a little bit of change happen where investors are looking outside of these sort of pretty efficient markets for new opportunities, and they're looking for a couple different reasons. One, because just frankly, the valuations tend to be a little bit less inflated, but also you're finding that like corporations are starting to diversify their HQs, just to use something in popular lexicon these days, and you're finding pockets of expertise, mortgage tech in Columbus, Ohio, healthcare and healthcare tech in Nashville, and so the ability for Fintech to be more dispersed and distributed obviously makes sense. Charlotte is a great example of a major Fintech capital that's not in New York City or downtown Manhattan. And so I think that the mood is changing and the opportunity is changing. I think the biggest change in that regard, however, is that there are a lot of people working in Bank of America, in SunTrust, in BB&T that are saying, I got a good idea, and I think I can take what I've learned here and apply it entrepreneurially into something more interesting and more disruptive to the big cathedral in which I currently sit. And they're able to start to find that capital locally to help accelerate that disruption. So I think it's changing, it's slow. New York is still sort of the economic or the financial capital of the globe, but I think that the ability to start chipping away at that is starting to grow and accelerate.
Yeah, I would add, again, I grew up here, and as I started my first company in 1995 as a tech entrepreneur in Charlotte. It was pretty challenging. Over the last 23 years, I've raised tens of millions of dollars, but a lot of it was on planes, and so I had to go other places to get money. And so just seeing the ecosystem's development is exciting and powerful. But I will say that I think the fintech companies, these startups that we're seeing that have emerged, you're kind of going to get to this sort of generation 2. So I spent 5-6 years on the Lending Tree board. Obviously we have Red Ventures and these other companies that people that have had that startup experience, seen those companies grow to scale, are leading not only the banks and more corporate institutions, but some startups that have really achieved kind of breakout scale. And as those people start to invest locally, start new companies, it's sort of a virtuous cycle. And so, and I'm looking at the market from a purely angel perspective because we have 250 angels, but we've deployed over $30 million just from angels in the last number of years here in the Southeast. So that's a very focused, just angel dollars. So it pales in comparison to some of the sizes of funds that you hear out there, but those are angels writing personal checks in this market. So I think the tide is shifting.
Yeah, I think one of the best things going for an entrepreneur is to raise $2 or $3 million and get to 10 or 15 million recurring revenue in a software business. That's sort of where we come in, and we are very familiar with overpaying for those businesses, and the return that you and your investors can get is fantastic. And I think that's driving a lot more kind of early stage capital and a lot of talent, as you said, to sort of leave the bigger companies if you're so inclined and start on that journey. It's a lot of fun to get involved at the stage we do when it's sort of hit that $10 to $15 million inflection point. But we also see the value, and that's changed a great deal. And a lot of investors in the growth space have really started to recognize sort of how valuable those assets are and are really paying pretty nice premiums for them. So I think that's driving a lot of capital formation and talent into that strategy.
Great. So let's dive a little bit deeper into breaking down what you all are currently seeing in the fintech capital market. What are some of the hot sub-industries in fintech you're specifically focused on? And if you haven't done so already, give the folks in the audience a flavor for where your funds are specifically focused. Constantly keeping an eye on what stage you are in the process as well.
Yeah, so we are very vertically focused, so we don't invest in a lot of like horizontal technologies. So we're typically looking at companies that are vertical specific in their solution, or maybe they're focused on like compliance or risk or workflow, but it's generally for a certain sort of industry or group of industries. So we continue to see a lot of opportunity in that area. A lot of our companies are not change the world kind of horizontal technologies. They really are kind of more like point solutions. A couple of things that we've done recently in the fintech space, we actually have a company in Fort Mill. It's a little bootstrap business called Access One that we took a majority stake in about 3 years ago, and have subsequently made an acquisition of their largest competitor. And they're focused on payments and financing plans for high deductible insurance plans for provider systems. And so it's a really interesting way for hospital systems to provide financing solutions for their patients to kind of help with like engagement and revenue cycle management. And then we also have a company we invested in a little under a year ago that's headquartered in Vancouver called Agreement Express. And Agreement Express has actually has automated onboarding software for both the payments industry and for the wealth industry as well. So for registered investment advisors and custodians, and then for the different kind of payments providers. Both of those sectors are under a lot of pressure with new technology and kind of new solutions, and they're looking for ways to kind of onboard their clients faster. So those are examples of the things that we would look at in two companies that we've actually recently invested in.
So, for VentureSouth, again, this is a professional angel network. We are sector agnostic, so we don't really focus specifically on fintech or health tech or anything. So we have kind of a broad focus. The first big filter, though, is Southeastern companies. We are geographically focused in terms of where we deploy dollars, which is good if you're here and important. We also tend to be one of the first checks, but a little bit more structured. And so unlike a friends and family round of maybe a couple $100,000, we tend to invest $600,000, $700,000 in a maybe $1 or $2 million round. So we often lead a round. We bring a little bit more professional structure to what would have otherwise been a angel or friends and family round. We probably, as a group, tend to think about our network intelligence. So you have 250 people with very different backgrounds, some corporate, some tech, some biotech. We look for things that are not too extreme on the edges. So we find investments that we think are maybe, payment processing, maybe there is, but it's not necessarily AI or blockchain that may be a little more bleeding edge or cutting edge. That's not the risk that our investors are typically looking for. So we're looking for companies that have demonstrated they're generating revenue, they have a customer, but they are kind of trying to find that first institutional capital to build it out, prove it up so Richard can buy it a few years later. Yeah.
We love the other stuff.
Yeah.
So for us, so we see quite a few opportunities to invest in really early. I would say that we're not necessarily napkin stage investors. That's more the purview of angels and friends and family, but sort of once a company has been formed, and once the entrepreneur is full-time, and once it's on its path to, I call it sort of that great path to $1 million in revenue, if it's a consumer business, 1 million users, or what have you, that's really interesting to me, because the business has been able to test a few ideas and say, you know what, I'm not 100% certain that this is going to be the end use case, but I've got a good hunch about the go-to-market, I've got a good hunch about who some of the customers are going to be, I have a good hunch at how to get to those customers, either a tops-down approach or a bottoms-up approach. I heard somebody mention earlier today, and that's when I like to come in, and that's when we really look at a lot of the subsectors that are really excited about now, one of which is obviously InsurTech, which is huge and broad, but as you're seeing sort of the ability to create these defensible moats in these highly regulated businesses around insurance, around banking, it's really exciting to leverage new technologies in these disruptive, or in these regulated spaces. So I see a lot of acceleration of that happening. I see a lot of things, I mean, if I had $1 for every pitch deck that I saw that had AI or machine learning or blockchain, I would be able to invest in everybody's business. But we do see a lot. I recently invested in a company out of Columbus, Ohio called SafeChain. SafeChain does blockchain for title insurance. I think that there are a limited number of really, really solid applications of the blockchain. I think something is sort of invisible to most consumers as they do their typical real estate transactions, as title insurance is a perfect application for that. And then, we're investors in, neobanks, we're investors in sort of new forms of insurance that are coming out. And so we really like the space, and again, I like that it's a known entity and that it's highly regulated, and so the ability to be disruptive, there's sort of guardrails along that, and it's not necessarily just investing in the white space.
Great. So one of the things when we work with fintech companies, and the questions that we get a lot when we're working on capital raises, is about the structure of the investment, the structure that the investor proposes for the investment. Give a little color on your preferred investment structure and how the stage at which you invest might impact what structure you pick, whether that be preferred equity, a convertible note, common equity, et cetera.
So again, maybe a little bit of because we're looking at the world through the lens of a professional angel network, we tend to be one of the first kind of term sheets that companies are dealing with. We do negotiate relatively, I think fairly, but hard to get the terms that protect our LPs, as well as set the company up for success. What that typically looks like for us is a preferred equity round. We're not big fans of convertible notes for a number of reasons, but I've seen that kind of fall in and out of favor as an entrepreneur. Most of my life, I've raised money in convertible notes and had various outcomes, but VentureSouth really prefers a price round of preferred equity.
Yeah, I'll just say, look, I think most investors prefer certainty over uncertainty, and priced equity rounds provide a level of certainty that we can represent to our investors that we've done our work, and that there is a benchmark that has been sort of universally agreed to on valuation and on ownership and things like that. Obviously, I've invested in tons of convertible notes. I've invested in safes. It's not as preferred as a straight priced round for a lot of the reasons I just mentioned. But again, I think for the entrepreneurs in the room, like, you've got to be as flexible as your most leaned in option, right? And so if you're having, because a lot of the struggle I would imagine for entrepreneurs is trying to corral a lead and then sort of syndicate that round to complete, and somebody doesn't want to price it, and so you're trying to, you've got 3 or 4 people knocking at the door, and you want to take the money because you need the money. So there's a great amount of deference for that as that entrepreneurial process. So I think you try to corral the round as best you can. If you can price it, it's usually better, and it usually sets the company up for success. The most dangerous thing I see with bridge notes and safes is as they start to get stacked, it makes the company less and less likely to get that sort of really good professional, institutional-led, investor, venture-led round. And so if you've got three successive rounds of $2 million bridge notes, some investors got to come in and say, all right, I've got $6 million of bridge overhang that I've got to clean up. And that's usually going to come, frankly, out of the entrepreneur's hide, because that next investor is going to come in and say, well, I don't care what you did before I showed up. I want 20% of the business, and here's my check. You figure it out and deliver me my 20% equity. Thank you very much. And so then you've got to work that out. So I think that the structure is as much up to the investor, but as the entrepreneur is trying to corral that, it's really got to be thoughtful about sort of the future fundraising pattern of the business and the cash needs that the business is going to need over time.
And we're flexible. We invest both in preferred and common, just kind of depending on the situation and our ownership level and the valuation, and kind of all kind of comes together in a little bit of a puzzle. So sometimes it ends up one or the other. And one of the things that we really focus on is an equitable outcome for the team and the investor base. That's very important to make sure everyone is kind of motivated and headed in the same direction. And so we spend a lot of time communicating with the management team on sort of what our checkpoints are and sort of how we're underwriting the asset and what we think the outcome is going to be, and making sure that kind of lines up with sort of an outcome and exit that they feel good about, so there's no kind of surprise at the end and everyone is kind of motivated to pull in the same direction.
I just wanted to piggyback on something David said, because I think, again, having been an entrepreneur more of my life, I made the mistake early on of when I had an investor willing to write a check at what I thought was a high but good valuation. I was excited as the entrepreneur. I missed the fact that subsequent fundraising would be more challenging. And so, again, VentureSouth, puts a lot of emphasis on coming up with a kind of fair, reasonable valuation. Sometimes it's lower or might be disappointing to the entrepreneur who says, I had a West Coast firm offer me, X pre-money valuation, which is higher, or looser terms, but that does not set up the entrepreneur or the investor for a lot of kind of smooth glide for future fundraising. So I would just encourage the entrepreneurs in the room to really think about that, particularly if you are like most entrepreneurs, you're gonna need more than one round, to look at the first round as a, achieve what you need to do in terms of mission vision, but set up the next round. Don't, challenge yourself with the next round. So I think that's important to know.
Yeah, and this is a good transition. The last piece I wanted to, or topic I wanted to cover with you all was some advice that you might have for the entrepreneurs in the room who are out raising capital or have raised capital. So piggybacking off of that, what are some of the do's and the don'ts that you would give to a founder in the room when they're going through the capital raise process? What are things they should look out for? There are certain terms in a term sheet they should look out for. Just some things that you've learned from being an entrepreneur and now being an investor.
Yeah, since I was talking, I'll keep talking about it for a second here. I also just noticed in the picture, I do own more than one shirt. I'm wearing the same shirt. That should never happen again. Sorry, that just caught my eye.
It's a good shirt, though.
Yeah, I love the shirt. Wear it every day. One of the things that VentureSouth we find kind of funny, but it's actually disappointing. So I would say to the entrepreneurs, most firms want to be flexible. They want to work with great entrepreneurs. They're excited to see deals. VentureSouth has looked at over 1,000 deals that are kind of in our tracker in the last number of years. That's a lot of deals. And one of the first things that filter companies out is they don't follow the very clear and easy to read criteria on our website. So they send something in that absolutely does not fit our preferred way to receive things or our very clearly stated this is where we invest and how we invest. So a lot of companies probably get filtered out before they even have an at-bat effectively, because it just is an indication that as an entrepreneur, you may not be great at kind of staying in what you're going to need. So I would sort of encourage you, as you talk to investors, to the very first thing you do is do your diligence on who you're sending your emails to. Another one I get a lot of is, it'll say Mac at the top of the email, and I have this great thoughtful thing, and at the bottom it'll say, thanks, Richard. Like, you just copy and pasted that email. So make sure that you're taking the time when you reach out to each investor to be thoughtful, because that's an easy way to get filtered out before you even start.
Yeah, for me, I would say the biggest piece of advice, and this kind of goes a little bit back to sort of the valuation, dilution, capital raise triangle. And for me, the biggest thing for entrepreneurs that you can control as the entrepreneur is how much cash you're going to raise. How much cash do you need to get to the next milestone? And you'll always, well, not always, you frequently see entrepreneurs want to raise a $20 million round because that's what, Uber's second round was a $20 million round or whatever. And like the worst thing for startups, believe me, is too much cash on the balance sheet. It leads to mischief, it leads to mission creep, it leads to overhiring, it leads to so many bad practices that you want to raise just enough with a little bit of obvious buffer to achieve your next set of milestones. Your valuation, you'll be rewarded with hitting those numbers, you'll be rewarded with higher valuations, you'll be rewarded with sort of saying what you're going to do and then actually doing it. And all of that will manifest itself in a higher valuation from a larger array of institutional investors that will be interested in you because you've successfully completed your Series Seed round on time, delivered the product, delivered the milestones on time, on your capital budget. And I think it leads to, it's so powerfully inertial to investors to see that you've been able to do that. And I hate to see, I'm dealing with a portfolio company of mine now that wants to raise a $30 million round. And I said, well, what are you going to do with the $30 million? He's like, I don't know. And it's like, well, then don't raise. Like, that's costly to you. Every additional dollar that you raise is coming out of somebody's pocket. And right now, it's going to come out of your pocket, especially if you don't know what you're going to do with the money. So my big headline suggestion is, you know how much you need to raise to get to that next set of milestones. We can play around with valuation, we can play around what percentage of the company that we're going to take in the investment, but you know how much money that you need to raise, and I would only raise that amount of money.
So I've got some good news by the time you sort of get to my stage, I'm selling you. You're not selling me. So, I'm the one that needs. So we're literally meeting in your conference room, trying to convince you that we're the partner of choice for like your next stage of growth. And so a lot of the companies that that we are pursuing definitely have a lot of options, including doing nothing. Just kind of continuing to sort of along with the current trajectory that they're on. But again, there's a lot of demand and a lot of options for $10 to $20 million recurring revenue software companies, and we're out there every day, kind of getting to know them. Really, a lot of times, a year or two before they even hit that point, just to make sure we've got a good relationship, and we're trying to get well positioned to kind of break a tie between us and probably 2 or 3 other groups that's pursuing that same company. So once you get to that stage, the tables definitely flip, and we're sitting in your conference room, not the other way around.
Piggybacking off that, when companies are in that position, what questions should they be asking you?
Yeah.
What should they be looking for in either, and this is for you guys as well, what questions should the fintech founder be asking an investor or be asking the company who could be acquiring the company?
Yeah, for us, I think it's a lot of our investments, we've got a founding team or existing shareholders that are rolling maybe 30 or 40% of their stake. And so valuation is definitely important, but in a lot of our investments, we're not the highest valuation, but that doesn't mean you can be 20% off. I mean, you can be you can be in the neighborhood, 5 or 10%. And it's become a more efficient market, so valuations are generally pretty tight. And then it's cultural fit, it's alignment, it's certainty to close, it's track record, reputation, and then value add. Does that investor really understand your business as well, or maybe even a little better than you in terms of like that next stage of growth? And what are they telling you they're going to kind of bring to the table to help navigate that resource-wise? Anyway, that's my 2 cents.
I would just say, ask for another portfolio company reference, ask to talk to the people that we've worked with previously, and we do our diligence on founders. We fully expect founders to do our diligence on us and understand the types of deals that we like and we invest in, who we are as VCs, and sort of what both our reputation is like in the world, but also more importantly among our portfolio companies, because those are the folks that we work with every day. I think the other thing to also always ask and always be cognizant of is, when will you stop writing checks, right? Because a lot of times you get hot and heavy off of the first big institutional investor, but their fund is only able to write 1 check, and you're going to need multiple rounds of investment, and then you basically have to start all over again if there isn't enough capacity in the fund to continue writing investments across the different stages. So, always check your references on the VC and ask them sort of when they will stop writing checks.
Yeah, I think the reverse diligence is a key part of the process. One of the specific things I would ask is, you want to know, particularly with their other portfolio companies that they've invested in, they're on the boards of, how do they deal with the challenges? And so it's easy when everything is going great, but when your core thesis kind of fails, or you have to pivot, or your co-founder leaves, how has that investor worked with you? Have they been sitting with you at the table, or have they been adversarial? So I think understanding how people deal with negative situations, how investors do that, is really important. And then the other, Richard said, the certainty to close. Probably the most frustrating thing I had in my life as an entrepreneur was leaving meeting after meeting with good meetings, feeling like, man, that was great, Richard loves what I'm talking about, and then no check, no term sheet, no follow through. So as an entrepreneur, you really have to manage that process and get confidence that they're going to write a check, or you're wasting time. And so I kind of feel like you have to take charge of that process a little bit. And ask around about their likelihood to close, look at their numbers. A lot of people publish, we invest in 3% of the companies we look at, so you can look at that stuff. But you want to get confident that just because you have a good meeting doesn't mean they're going to write a check, and you need to get a check.
And it's totally fair to say, well, what's going on? Are you guys in or are you guys out? Like,
Where
it's,
are you?
you know, it's a totally fair question to ask,
Absolutely.
because sometimes our priorities shift, and, you know, while your fundraiser is the most important thing to you, it's like one of 30 things that I'm working on, and so it might just fall sort of down a little bit on my email list, but it's a totally fair question to ask, and usually the answer is going to be no if you have to ask, but sometimes getting a no and moving on is actually just as helpful as being strung along.
Yeah, investors like optionality, so it's like, I don't have to say no, I'm not gonna say no.
The long
They're just getting late. So, so sometimes until you push them for that definitive answer, they're just gonna string you along for sure.
Yep. Well, thank you guys. Thank you, David, Richard, and Mac. We just ran out of time. Timed that pretty perfectly. The timer just went off. Appreciate your time, your thoughts, your insight. If y'all would just give these guys a hand for